Hello and welcome to the 200-day moving average class for the Big Trends Indicator Library. My name is Scott Downing and I'm going to be your instructor for this class. Now, a lot of people just use the 200-day moving average as a longer-term broad support and resistance level. And there is a lot of utility in that application. Um, you will see a lot of success in using the 200-day moving average as that broader, longer-term support and resistance level to give you some areas that you need to pay attention to, because when that level of support or resistance is violated, oftentimes you see very significant move. However, we have taken the indicator a step further, and we have some very interesting opportunities for you to use what most people think of as a very basic indicator in the 200-day moving average, and found some ways to really spot some explosive, fast-moving trends that give you lots of profit opportunity. So we'll go ahead and get started. Access to Big Trends and its coaching services is provided for educational and informational purposes only. The information presented here does not constitute a recommendation to buy or sell any particular investment. You are solely responsible for your investment decisions. Now, there's all kinds of different common uses for moving averages in trading. Moving averages have really been around since the beginning of time of trading, so to speak. So there's lots of different moving averages out there, lots of theories and beliefs about moving averages. But let's take a look at some of these. The most basic is trend identification. So am I in a bullish or bearish trending environment, or am I in a neutral environment where there is no trend? Obviously that's determined on the shape of the line. So if you have a bullish trend, you're going to see a moving average that looks something like that. Bearish is going to be the opposite, and then no trend is just going to be a relatively flat moving average line. Some people use moving averages as momentum indicators, where they will take some multiple different time period moving averages and plot them on the same chart to look for crosses of the two moving averages. That's obviously not going to apply with just the 200-day that we're looking at here today, but always remember that there's other opportunities for you to combine some of those different time period moving averages and ultimately find ways for other profit opportunities. Some of the more common ones in terms of the longer term moving average, like the 200-day, is going to be support and resistance. Now, said a different way, support is going to be a level where typically a lot of bulls jump in, and so it provides somewhat of a potential bottoming process. Resistance is going to be the opposite. It's an area where a bunch of the bulls exit and a lot of bears like to short a particular security. And so that gives you some sort of an area of where a particular stock or security might have a little bit of a pullback. And then finally, you can use moving averages as exit points to let you know, if you can use them as trend identification tools, then you also can use them as an exit point to let you know when the trend is ended and when you need to be done with that particular trade because it's no longer trending and move on to another bigger, better opportunity. Now, the 200-day simple moving average is typically what we're referring to when we're talking about a 200-day moving average. Although some people do use exponentials and weighted moving average, for the longer term, we find that the simple works the best. Now, you should be starting to become somewhat familiar with our concept of acceleration. The whole goal of the majority of our big trends indicators, or the indicators that we've put our own spin on through this indicator library, is to try to find acceleration points, either to the upside or the downside, but taking that whole trending environment a step further and saying, not only do I want to find a trend, but I want to find the fastest moving part of that trend where it really starts to accelerate and get going in that direction. Most people think that you can't do that with a 200-day moving average. And to a certain extent, that is very true. But if there are key support and resistance levels that take place at some of these moving averages, then there is opportunity for you to profit when you do see some of those moving averages violate or hold their levels, depending upon what the price action is at that particular period of time. So what we started to do is studying stocks that were above their 200-day moving average. Why do we do that? Well, to take a half a step back, 200-day moving averages are critical levels. So you want to take a look at some of those key support and resistance levels and determine, the stocks that were above their 200-day moving average or below their 200-day moving average, and get a little bit of a feel for the relationship. Now, markets in general have a bullish bias to them. In particular, the stock market has a bullish bias to it, because the theory is, over the longer term, that stocks are going to be one of the best performing assets. So what you're going to see when you're looking at a broad stock market is over longer periods of time, and sometimes that means 10, 20, 30, 40 years, so really, really long periods of time, you're going to see more often than not that the market is going to increase in value. However, we're not dealing in a 10, 20, 30, 40 year time frame. We're dealing in much shorter time frames where we're looking at weeks, days, or even down to the minute as far as what the price action is doing. So we need to find a different way to take moving averages and to be able to apply them to the shorter term trading. Since markets do have that bullish bias, though, you'll often see that bullish bias takes place even on some of the shorter term time frames. Yes, you will get bear markets that take place and wipe out some of the bull runs that will have occurred before it. However, bull markets can be very powerful because they are usually very trending, very long trending, where a lot of different people want to get on board the trend. And until it becomes oversaturated and too many people have gotten in and the trend starts to either end or violate and reverse direction, a lot of people like to pile on that, and that can make a stock really move and really accelerate in one direction or the other. So after we studied those stocks that were above their 200-day moving averages, there were some interesting results that popped up. Mainly that stocks, since the market has a bullish bias, if you get a stock that is above its 200-day moving average, more often than not, you're going to see that that bullish run, is going to continue and accelerate much further from that point. And as I mentioned earlier, that acceleration is what we're looking for. So then the question becomes, how can we take that acceleration and put it into an indicator to let us know when we're really starting to get that movement that we're looking for? One of the best ways to do that is to first of all plot the 200-day moving average on your chart. Once we've done that, we've also developed a separate indicator based upon the 200-day moving average to give you some information. So let's take a look at that and some of the rules. Now, by definition, since markets have a bullish bias, this is going to be a bullish only indicator. So this is an indicator that's not going to work for you in a bear market. So first and foremost, you have to be aware of that particular situation. You have to understand your indicators, how they're designed to work, and where they, the type of markets that they best fit. The majority of the indicators that we teach you here are going to work in all types of market conditions, both bullish and bearish. However, in non-trending markets, where we're in a choppy range-bound market, a lot of our indicators aren't going to work that well, and that's by design, because we don't want to trade those environments. We want to trade the really strong, accelerating, trending environments. So with this 200-day moving average indicator here, it is going to be bullish only. So there's not going to be any bearish entry or exit rules, which does simplify things